Good afternoon, ladies and gentlemen. My name is Alwyn van der Merwe, and I am the Chief Investment Officer. So from my side, a warm welcome to each and everyone. I also want to welcome you on behalf of Carl Roodman, the Chief Executive Officer of Sanlam Investments, and on behalf of Craig Massey, who is our Chief Executive Officer at Sanlam Private Wealth. So to all of you, a warm welcome. I also want to welcome my colleague Renier de Bruin, who I dare say is now a seasoned investment professional, one of our senior analysts, and apart from being an equity analyst, he's also assisted me on the asset allocation over the last year. So Renier, welcome. Between Renier and myself, we would like to take you through a macro overview. And then once I've done the macro overview, I will pass over to Renier to discuss the holding of Naspers and Prosus, which of course is the most important share in our local equity portfolios. And of course, Tencent is one of the shares that we hold in the offshore portfolios. So within that basket, that was extremely important for us. It went through a patch of bad performance. We've also traded quite actively in the particular share, and I think it's just very apt that we share our views on that very important asset. So without further ado, I would like to start the presentation, and I would like to start with a macro overview. And ladies and gentlemen, I don't think that it should be any news to you, because like us, I suppose most of you are also punch drunk, given all the negative news that we had to absorb over the last 9 months or so. In the last 9 months, we've seen the inflation rate kicking up significantly to numbers that we haven't seen since the late 70s or the early 80s. We also had to deal with a very high oil price, with the Brent crude oil price trading beyond $100 a barrel, and in fact, at one stage trading $125 a barrel. As a result of that, we've also seen that interest rates have either started to go up in some of the major economies in the world, or we have threats that those interest rates are going to go up. And for those that didn't notice, it is interesting that interest rates in Europe hasn't gone up yet. And the last time that those interest rates went up was back in 2011. So we're dealing with high inflation, high oil price, interest rates going up. And at the same time, we also see that the momentum out of economic growth is starting to lose steam. And with all of that, we also see that some commentators are talking about the potential risk of a recession. And then just to crown everything, these events, of course, had a major impact on the performance of financial assets. And as you've seen, offshore equities in particular performed quite poorly since the beginning of the year. So the point is, if you throw all of that in a pot, you know, what do we make out of that? And how do we run other people's money with that as a background? So I think it is just important that we just take a step back and then see if we can get a proper perspective or a correct perspective in terms of what is happening around us. Now, the first point that I would like to make is to share with you that, you know, economic cycles are not uncommon. If you look at this particular slide, this just shows you the real GDP growth rate of the US, and it goes back to the 1970s. And you can clearly see late 1970s, you can clearly see we're talking about a 42-year period. And in this 42-year period, you had it was quite common to see periods of recession. That is where you see these blue lines or the blue bars going below the zero line. And over these 42-year period, you will see that we had at least about 6 periods of declining economic activity. In other words, where the size of the cake actually shrunk. It is also interesting to note that in the late 70s, early 80s, it happened quite quickly. And then we had a very long period from the early 90s until 2000. And then, of course, that was the great financial crisis back in 2008, 2009, and then very extended period of positive economic growth. And that upcycle was ended by the outbreak of COVID and the lockdown of people, or the restriction of the economic mobility of people, led to that crisis. What is less uncommon, though, is the size of the decline that we've seen back in 2008. That was a great financial crisis, and also, or the extent of the decline. And similarly, after we've seen COVID, you've seen quite a deep recession at the time. And in both cases, we came out of the recession largely as a result of very strong stimulating activities done by central bankers, by dropping interest rate, by creating money, and also by fiscal stimulus at the time. And particularly after the crisis that we've seen early in 2020, you've seen a remarkable recovery in economic activity if you look at that last set of blue bars. However, it's also quite clear from this particular chart that the blue bars are starting to come off. So economic growth is still positive, but the growth rate is declining at a rapid pace as we speak. Unfortunately, we've got to admit that economic cycles do matter for the performance of financial assets. So what I've done on this particular slide, I've simply overlaid the 12-month rate of change of the S&P 500 over the economic growth cycle that I've just shown you. So if you look at the period in the early 80s, you can see when economic activity came under pressure, the black line dropped to below the zero line. And in this case, we measure it, the black line, we measure it on the right-hand scale. So you can see when economic activity came under pressure, you've had a decline in the performance of equities. At one stage, they were growing at about 30% per annum at that time. And if you look at it, it was a period of significant declines where it dropped about 20%. And so you can go through the slide, and without exception, when economic growth started to slow or went into negative territory, the equity market followed. So that is just how it happens in financial markets. So as asset managers, we need to take cognizance of these particular movements, and then, of course, take that on board when we manage the money of clients. And you can also see, if you look at what has happened in 2020, you've seen a rapid decline in economic activity, a rapid recovery, and you can see the black line responded quite aggressively to the recovery in economic activity. What you can see now is that despite the fact that the blue line is still in positive territory, in other words, the economy in the US is certainly not in a recession, the black line shows you that on a year-on-year basis, the S&P 500 index is down by about 10%. Or if I look at the last 6 months, the S&P 500 is down about 20%. And if you want to be more negative, the NASDAQ index is down by about 30% since the beginning of the year. So this is the reality that we need to deal with. We don't need to be emotional about it. We didn't put the script together, but we can manage assets in these scenarios. And when the scenario becomes a bit more difficult, I think you would agree with me that the intention should be to protect capital rather than to be aggressive when you manage other people's money. So I would just like to look at the current reality. I think I've highlighted many of those factors in my introduction. The first thing is we've got to recognize that the inflation picture has changed fundamentally in a very short period of time. If you look at the left-hand chart, it simply shows you the US CPI or the US inflation numbers. And if you look at the blue line, it's the headline index. And if you cast your eye to the left-hand side, you will see that inflation, the headline numbers, consumer numbers in the States are now, prices are up by more than 8% in this particular basket. What is also important, if you look at the black line, which is so-called core CPI, so it strips out some of the volatile items out of the inflation basket, even that number has gone up significantly. So when authorities sit and they strategize around what they should do in trying to control some economic variables, they cannot ignore the fact that inflation has gone up. And if you look at the right-hand chart, that is just European inflation. The trend is exactly the same. The scale is a bit different. And you can see inflation is up to 8%. And maybe I should just quickly, before I go on, try and focus the attention on the left-hand chart. Just look at the 70s. We had inflation going up to 6%, came under control a bit, then it went to 12%, so double-digit inflation in the early 70s. It came under control again, but only went down to about 6%, and then we had an explosion in inflation towards the end of the 70s, where the consumer inflation rate went to 14% at the time. In Europe, not the same kind of experience, but now you can see in Europe, cannot escape this. Now, of course, this is largely as a result of very strong increases in energy prices. That will, of course, include fuel prices and food prices as well, two of the major driving factors of these inflation numbers. We think that these numbers should roll over, but these numbers and the rapid pace of the increase certainly has focused the attention, got the attention of central bankers. So that is on the one hand. On the other hand, we spoke about the very strong economic recovery after the stimulus that we've seen from central bankers across the world. And you can see now, and this is a very short dated slide, it just goes back to the beginning of 2020. Global economies went into recession, and I show three economies here. The three biggest economies in the world, the blue line, the US, the brown line, China, and then, of course, Germany. So you can see that Germany and the US responded very quickly, and these are simply just the PMI numbers. It's normally a leading indicator. So when the line is above the 50 index number, it means that economic activity is in an expansionary phase. And you can see that the momentum in the economy actually picked up. But since about the middle of last year, you can see that although these numbers remain above 50, that the momentum started to come off. And it's now very, very close to that 50 number. That would suggest that if it goes beyond that, it normally leads to a recession in these particular economies. So that is the first point to make. The second point to make on the slide, and René will talk about that later on when he talks about Naspers and Prosus, is you will see that the world as we know it, in terms of economic activity, was what we would call out of sync. Whilst there was strong growth in Europe and in the US, in China, they didn't share that. And that is partly as a result of COVID and the, excuse me, and the rules introduced to try and isolate people and restrict the economic mobility of people in China. And you can see that the Chinese economy just sat around this 50 level, which means that economic activity was quite muted at the time. And then if you look at it in this year, you can clearly see that it came under more pressure. And now in the last 2 months, we've seen a recovery. And the reason for that is that the Chinese authorities are starting to open the taps, and they are relaxing economic policy in China, where in the US and in Germany, we get exactly the opposite. So the world not in synchronization. René will talk about that brown line in more detail later on when he addresses Prosus and Naspers on RBR. The last point that I would like to make on the current reality is that interest rates are going up. So if you look at the blue line, that is the Fed funds rate. And you can see that Fed funds rate was sitting at about 0 since the great financial crisis. Went up a bit and then went down when we had COVID. And only now for the first time, we are seeing that interest rates are going up. So that is the one thing. The second thing is if you look at what the market expects, and that is the so-called Fed funds future, and I've got 2 year, what they think in December 22, and then what they think interest rates will be in December 23, you can see that suddenly the market said that interest rates will need to go up higher relative to where it is now. And the rate is roughly about 3%. The other point that I think one needs to make is, if you look at the US core PCE deflator, that is just another measure of inflation. I spoke about the 70s. If you look at this blue line, it was very high, came under control, and now you can see how it is picking up. The point is, if interest rates are going to go up, and they go up in the same real levels as where they've been, if you just go back to the early 2000s, then interest rates need to go up more than what the market expects. So what the market is now saying is that they think that inflation should be under control and will come back to round about a 3% level. If that is not going to happen, interest rates might well go higher. So that is the reality. What we need to deal with now. But we normally say that financial markets are forward-looking. So we don't think we can forecast, but we think that at least we should be able to formulate a view of what we think can happen, and then assign a kind of a probability to the different scenarios that we think can emerge in future. Now, in essence, we said that there can be about 3 scenarios. There can be a soft landing. That means that the Fed is successful in getting inflation under control without pushing the US economy into recession. We don't attach a high probability to it because it's never happened before. That is the first point. Secondly, there's a very reliable indicator. We call it the so-called the slope of the yield curve. And that yield curve has gone negative, which normally means that that is a sign that over time, the market expects the US economy to go into a recession. So that is the one scenario. The second scenario is, well, you get inflation under control, but you pay a price. And the price is you go into a recession. So if you do go into recession, then we've seen what happens to financial prices. And then the third possibility in terms of a scenario is you get high inflation and you get low economic growth. Not necessarily negative economic growth, but low economic growth. That is in essence what we have seen in the 70s. And in the 70s, it wasn't a good period for the performance of financial assets or the traditional financial assets. There were assets that performed well, and I'll come back to that. So when will that happen? That happens when the Fed pushes up interest rates. The Fed sees that, oh my goodness, economic growth is coming under pressure, financial markets are coming under pressure, and I'm not prepared to pay that price to get inflation under control. And then the Fed says, I'm going to take my foot off the brakes. I'm not going to hike interest rates further because I want to protect the economy and I want to protect financial markets. So we will have, and that is why the market is so volatile around the announcements of how the Federal Reserve think about policy measurements that they are going to apply in future. But nevertheless, so that is what we have to deal with. So what is important to note, though, is there will be a different asset set appropriate for the 3 different scenarios. For instance, if we go into the soft landing, you know, we will just have to be patient with equities. The market will recover, interest rates will not be that high, and at some point the equity market will be cheap enough and it will recover quickly, so you want equities and bonds in it. In the case of a hard landing, there's some point that you don't, when you want minimal equities, and then, you know, when you think that the economy's gone into recession, asset prices are down, you just employ all your money and you buy equities as the investment clock advances. And then with inflation spiral, you unfortunately need a much bigger tool set to protect and grow clients' money, and I will go through that. just want to show you the 70s. Just put the magnifying glass on the 70s. The blue bars, just as in the first graph that I showed you, just shows you economic growth in the States. And you can see it was very volatile. Very strong growth in the early 70s, then a collapse, go into recession, decent growth, into recession, bit of a growth, back into recession in the early 80s. Why was that? The reason was they struggled with inflation. And you can look at and we measure the inflation on the right-hand scale. You can see inflation under control here in the early parts. Then we had the energy shock. Inflation rate went to double-digit numbers. If you look at the right-hand scale, measures to try and curb it did work. Economic growth started to pick up, and then inflation picked up again. And then the name Volcker came into play. Volcker was the governor of the chairman of the Federal Reserve at the time. He came into that position in 1979, and he said, "I'm going to kill inflation," and he did exactly that. The cost of that was actually quite expensive. You can see that they entered a period of very low economic growth, but it got inflation down to 4%. And that introduced the biggest bull market for equities that I have seen in my career. The stage was set for low inflation and low interest rates, in essence, over that time, and the markets loved it. But during the 70s, it's very interesting to look at how asset classes performed. If you look at the far right, in this very volatile and uncertain environment, equities gave a negative real return of 1% per annum over that period. And the important point to note is, you were not protected by the so-called safe haven asset, US Treasuries, also recorded a negative return during that particular time. And by the way, it started off at a point where it wasn't really expensive. Equity started at quite an expensive level. So I think this chart doesn't do justice to equities, because it did at times perform quite well. But it was interesting that if you look at what protected, and in fact, not only protect, but provided real returns over time in the 70s, was oil, silver, gold, and food, in this case, wheat prices. So kind of non-traditional assets. And I think that is one thing that if you run a multi-asset portfolio, one needs to take cognizance of that. So how do we navigate through this? I think what I'm trying to say to you by talking on the previous slide is, ladies and gentlemen, in this very uncertain environment, in a multi-asset portfolio, we need to diversify. You need a wider tool set as the old traditional bonds and equities. So that is the first point that we would like to make. And I've made that point before. You can look at this chart. This simply shows you the correlation between bonds and equities. So during the 70s, when this blue bar is above the horizontal line, above the zero line, it means that bonds and equities are correlated. So what you want when you build a portfolio, you want assets that are not correlated, because when the one goes down, you want the other one to support the investment performance. But in the 70s, these two asset classes moved in the same direction. So if they go down, both of them go down. So your drawdowns are quite severe. You think you are protected, but you're not. It was only really in the last, let's say, 27 to 30 years that we've seen that bonds and equities were uncorrelated. So they were great partners in a portfolio, because when the one goes down, the other one protects you. And that is really what we've done over the last 25 years, is to use those two asset classes in combination to produce a particular outcome. But, you know, to our mind, Bridgewater Associates, a great company, they said, you know, normally the market focuses on one of two things. The market focuses on growth, or it focuses on inflation. So when growth is rising, and this is not where we are, that is when equities and commodities normally do well. When growth is falling, that is normally when nominal bonds do well. But when inflation is kicking in, and the market focuses on inflation, commodities normally do well. So in our portfolios, you will start to see that we've included gold in these portfolios for the clients who are exposed to our offshore portfolios, we've specifically included exposure to energy, the whole energy sector. And of course, if inflation goes down, again, you want nominal bonds and you want equities. So if inflation is going to be an issue, and now just ignore valuation for a while, if inflation is going to be an issue, then you would like to have some commodities in your portfolio. And if growth is falling, I think you need some bonds. In inflationary environment, the one thing that we haven't included here, inflation-linked bonds is also a very handy asset to have in your portfolio, specifically in South Africa, where it yields 4% at the moment. I'm not going to go through that graph. The final point that I want to make before I hand over to Renier is the fact that, yes, this is the macro environment. Yes, we need to take cognizance of it. And if we go back in history and we go back 40 years in history, we've learned a lot of lessons. But the one thing that we cannot ignore is the fact that valuation always matters for every asset class. So fear will take asset prices down, greed takes asset prices up. And I think it is true to say that we've already experienced a lot of fear in our market. And I'll just demonstrate that by showing you a very simple chart, and that is just the Aussie. So that is listed shares on the South African market. And you can see that every now and again, the South African equity market sells off. So this was a prolonged period, really since 98, when South African equity market went nowhere, then came off in the first quarter of January 2003. And it traded at a level of about 8 times, a price earnings multiple of about 8 times. Then if you go to the great financial crisis, of course, the financial crisis was there, but the share prices responded when the market went down from levels of about 30,000 points to about 18,000 points. And again, on a PE basis, it went down to a PE multiple, a price earnings multiple of about 7 times. Similar story during COVID. And now you can see it is as if the market is saying, whoops, I'm quite concerned about the economic scenario. And the market has already given back quite a bit of the upside. If you look at our market, again, on a PE basis relative to these 3 dots that I've highlighted here, in all 3 of those occasions and now, the market is trading at about 1 standard deviation below its long-term mean, which means roughly a price earnings multiple of about 8 times. So is it time to sell? Remember that in the multi-asset portfolios, we have taken money off the table 3 times already. Way too early, late in 2020. Then again in the second half of 2021, and then again in the first quarter of this year. So we've already introduced much less risk in the portfolios, and that created, if I may use a very blunt English term, dry powder. So should the market come back further, that we can actually utilize the opportunity to buy these hopefully cheaper assets. And then just finally, did this recipe of ours work? And I've just pulled out the SPW balanced portfolio. It's a model portfolio that we run internally. Many of you who might have a balanced mandate with us, Regulation 28 compliant, your assets will look very similar to what we've got here. And I just want to highlight the 10-year performance. And you can see over the last 10 years, this particular portfolio produced a return after cost of roughly about 9.6%. The average competitor did 7.9%. So quite a significant outperformance. And in fact, if you compare it against the whole range of competitors over the 10 years, we have outperformed 89% of those competitors that compete in this particular space. So ladies and gentlemen, I think the recipe that we have followed in the past has worked. I also think that, you know, as I said, we didn't write the script, but we need to interpret the script and then ultimately run portfolios to make sure that we protect at the right times, but then also position the portfolios to help you to generate long-term capital growth when assets are cheap. So from my side, I'm going to stop here. and then I'm going to hand over to Renier, who will take you through Naspers and Prosus and answer the question, and keeping to the question, has the tide turned?
Good evening, everyone. Thank you, Alvin, for that introduction. So just to provide some perspective, I'm going to start with this chart that just shows you how the Naspers group, now if I refer to Naspers group, remember that over the last few years, a Naspers shareholder would have received Prosus at multi-choice shares. So as a group, this chart just shows you how that their share prices have performed relative to the South African equity market. So if you've got a rising chart like this, it means that the Naspers group has done better than the average or the SA market in this period. You can clearly see how it has underperformed. And I just want to call out a few things on this chart. So firstly, this chart starts with the NASDAQ bubble in 2000, and over that period, Naspers has done much worse than the SA market as the NASDAQ bubble or the IT bubble deflated. But in that period, a very crucial thing happened, and that was the acquisition of it was a relatively small Chinese internet messaging business called Tencent that was purchased for around their stake for around $30 million. If you look back to that acquisition, really that changed things for Naspers in a dramatic way, and you can see how Naspers has outperformed the market. If you look at the scale here from less than 1 to almost 9 times. So 9 times the multiple of the market over that period. You can even see here in the commodity bear market how Naspers has outperformed. And you see a little bit of a wobble here in 2018, and that was sort of a period where we've seen the Chinese authorities clamping down a bit on the video gaming business, which is a key business area for China, for Tencent rather, and that was where investors started worrying about the prospects. But as you can see after that, despite that regulatory intervention, that Naspers and Tencent navigated that quite well and resumed the outperformance of the market. And you can really see the sharp outperformance during COVID, when firstly you had a lot of excess liquidity coming to the system that supported growth shares, but also a lot of these businesses were clear beneficiaries of faster digital adoption because people stayed at home and were basically forced to use internet services more regularly. What's interesting is that you can see the underperformance since then, and even despite, I think, some of the benefits or the faster adoption rate that should continue to benefit the industry, you can see that it basically gave up all and more of the outperformance after COVID. And there were really 2 big events that happened there. The first one last year, around this time, we focused part of the webinar specifically on Tencent and the impact of Chinese regulatory crackdown. But even more recently, we've seen that with the whole inflation and interest rate environment changing, that global internet stocks sold off a lot more than the market. And if you really look at this chart, it seemed like a dream company that turned into some kind of a nightmare. But if you look at the last bounce year, which really occurred over the last month, one would hope that we finally woken up out of that bad dream and that tide has turned. So let me start and just talk about high level what Prosus is as a business. Now, I might use Prosus and Naspers interchangeably here. Essentially, they own the same assets, so 99% of the value of Naspers is really their holding in Prosus. So essentially the same asset group. So if I refer to one or the other, for this purpose, we can almost see them as the same business. So firstly, they are a global investor into consumer internet businesses. They focus on high growth businesses, but the exposure is quite focused on emerging markets, and with particularly concentration towards China and India. So China through Tencent and India through quite a long list of businesses that they have invested over recent years. Now, what these 2 markets have in common is firstly, they have generally higher economic growth rate than the rest of the world. They also have very big populations, and they also have very high adoption of digital services. So very lucrative markets to be in if you're successful on that. But you need to be very competitive, as these are quite competitive markets. Secondly, is that very important is that Naspers is generally an early stage investor. Even with Tencent, which has recently been definitely on the top 10 largest companies in the world, they were an investor at the early stage with them. And that has been the case with basically all of the investments they have made over the last few decades. Now, bear in mind that if you're an early stage investor, you're not buying a mature business with profits, but rather you have to go through startup losses.
Working on that.
So your income statement is perhaps
I found
not,
this on the web for has recently been definitely on the top.
so excuse me for that. So there's been, you have to go through a period of startup losses. So your income statement doesn't necessarily look that great. So if you measure them from a income statement profitability point of view, that scorecard might not look that great. But if you look at them from a point of the value that they created in this business, I think that scorecard looks much better. Thirdly, is that they generally are quite venturous with the investments. So they make a lot of small scale investments to learn about the industry. And then once those investments, or for those investments that are successful, they would typically add a lot more capital and try to really grow those businesses. So generally, if they double up on the investments, the losses would increase for that period, but that's not necessarily a bad thing, because it means that they have seen that market develop to an extent where they see long-term potential in there. And then if I go to the next slide, this just shows you the portfolio of Prosus at the moment, and that actually excludes Tencent, which is between 80 and 85% of the value. But you can see there's a lot of assets here, and it a little bit looks like like Chris Becker at some point he said, like throwing spaghetti onto the wall and seeing what can stick. So there's a lot of investments in there, and it looks a little bit all over the place. But if you look at the structure on the next slide, you can clearly see there are certain themes that have emerged where Prosus have been shown that they're quite strong, or where they feel that they can win, and then they've doubled up in that by either through more investments in that investment, or adding more other businesses in that area. And those areas that I can call out really is on the classified side, on the payments and the fintech side, and food delivery, and also online education. So whenever analysts or commentators speak about the investment case for Prosus or Naspers, they often refer to the discount. Now, that discount really refers to the difference between the share price and the value of the underlying assets. And you can see here that obviously we've seen a major change in that discount after the reported on the 27th of June. So I've just said, okay, what was the market cap of Prosus on the 24th of June? You can see it was around $80 billion US, and that compared to the value of the assets. So on the one side, you've got Tencent, which is worth around $124 billion, and you've got the other assets, or what we call the RUM, which we've estimate is worth around $30.9 billion. So you're sitting with almost $160 billion of assets, but the market value is only $80 billion. What has happened last month is that Prosus announced that what they will do is they announce an open-ended share sale of Tencent shares on this side, and then they'll use that process to buy back their own shares at a lower price. So you're basically buying back into your own assets, but at a lower value. And the same can be said with Naspers, and probably to a bigger degree that you can see at you're sitting with currently the market cap is around $35 billion, and the assets are worth around $65 billion. And if we look at the history of that, and we know that Naspers management has taken a lot of criticism over the discount. There were lots of perception about them destroying value, that's leading to the higher discount. And that is that widening of the discount can clearly be shown on this specific chart. So if you go back to 2018 and 2019, you can see that Naspers has traded at a discount to the value of its asset of between 30 and 40%. And at that time, management and the market felt that number was too high. So because of that, that led to a range of corporate actions over the last few years. That included the Prosus listing. They bought back quite a lot of their own shares. There was also the share swap last year. But you can see, despite all that effort, that the discount kept widening, and the combination of Prosus and Naspers ended up at a discount of more than 60% in May this year. And you can really see that every time there was a corporate action, you sort of have a short-term lower discount, and that was just completely changed after that. And you can see what really, and if you go back to last month in the announcement of the open in the Tencent share sale and share buyback, you can see finally we've seen quite a dramatic change in that discount. But even now, that discount is only really back to where it was before they initiated all these transactions. So why is this time different, or will this time be different? Because clearly the previous actions didn't work. Now, before we say that, the previous actions they did only made a few investment bankers rich and really resulted in painful tax consequences for a lot of investors, we have to bear in mind that the structure has changed for the group over the last few years. So firstly, it is now a lot of the tradable shares is no longer into a South African listed, JSE listed entity. It has actually moved towards a Netherlands incorporated company. So definitely that is a more friendly structure from both a tax and foreign exchange point of view. And also the weight of the combined group on the JSE has reduced materially. Secondly, if you look at the share swap in August 2020, that really related to the difference, the much bigger discounts at the Naspers level versus Prosus, and that is why they offered Prosus shares in exchange for Naspers shares. The third one is different in the sense that, firstly, the whole benefit of this transaction is the fact that there's a big discount. So if there wasn't a big discount, they wouldn't be able to add value through this mechanism. But also, what's different than in the past, this one doesn't have a specific dollar amount or time frame. So it's really open-ended one. And despite the fact that the discount has immediately closed to quite a big extent, management is quite clear that they don't have a specific end goal in mind at this time, but that they will run it for some time. So I think for the next period, there should be probably a decent anchor for that will prevent that discount from suddenly going up materially again. Now, obviously, if we talk about the discount, there are many factors that has contributed to that, but I'm just going to focus on one perception, and that is, if we think that management is destroying the value relative to the assets that they already have, that should be argument for a discount. But if you look at some of the track record of management, firstly, I just want to show you on Tencent. So, it is a big part of their business. It has been a hugely successful investment, but you can see that they have actually started to reduce that stake in Tencent over the last few years. And if you just look at the timing and the value that they got for their shares, it does look like they did pretty well there. So around $25 billion of shares. So most of that went back into share buybacks at a discount. But some of it also went into supporting investments into the rump. And that is another big focus area, is like, if you look at the losses that assets out of Tencent has generated, you can see that that has been negative. So over the last financial year, Prosus has lost $1.1 billion from the investments outside of Tencent. And to some, that suggests that, they are losing money. But I think referring to the point I made earlier, is remember a lot of these businesses are startup businesses or early stage businesses that has to grow through that J curve. But how can we know that these businesses will ultimately be successful and not continue to make losses? I think that is where I keep a fine eye on the next chart, and that basically shows you the organic revenue growth that that portfolio is generating. So what is necessary for a startup business to become profitable? Well, you need scale. You need to grow your revenue, and then that absorb your sort of your fixed cost that you have. And that for me is certainly a positive. And you can see that over the last few years, the organic revenue for the rump of Prosus has grown at more than 50%. And if you compare that to what they generate from Tencent, you can see that even though Tencent was growing faster in 2017 or 18, that growth has slowed down. So certainly the rump from a top line perspective is not dilutive to overall growth at the moment, showing that they are clearly gaining the traction they need in this portfolio to ultimately become profitable. So obviously we can't talk about Prosus unless we also talk about Tencent. As I mentioned, Tencent still accounts for more than 80% of the value, so we need Tencent share price to go up. But maybe if I can just start with Tencent in a nutshell and give you a few interesting stats on that. So Tencent is the world's biggest by revenue producer and distributor of online games. So whether that's on your PC, which was their traditional business, and they were very successful in migrating that to cell phone or smartphone games. So they are the biggest in the world. And they've been continuing to grow their market shares over a long term. Also, they have been hugely successful in terms of the apps that they have rolled out. Now, if you think about the period that Naspers have owned Tencent, if you look at the biggest or the most valuable Tencent asset that Tencent currently has, it's an application called Weixin, or in English WeChat. We've got more than 1 billion users on that, and that was only developed in 2012. So it's actually only for a very short period. But the fact that they've got so much applications that people use regularly now, the average Chinese use their smartphone for more than 6 hours a day. And of that, around 35% of that time is specifically spent on apps that's owned by Tencent. But Tencent only owns 11% market share in terms of online advertising revenue. It clearly shows us that they've been under monetizing, or they haven't pushed that revenue streams relative to the value of their assets. Thirdly, I can talk about the fintech and also the cloud computing services, where they've been very successful and been growing quite fast over recent years. And if you think about, they're doing more than 1 billion daily commercial transactions. So in South Africa, we would typically go to the store, we'll buy using cash, or use our credit or debit card. In China, they use the QR codes to pay for everything that they do. And that is either with Alipay or with WeChat. And then finally, what we shouldn't forget is, Tencent has been a very profitable business, but they have only distributed a small percentage of that as a dividend. So what have they done with all that profits that they have retained? They have been a very successful investment or investor into a long range of assets. So they own more than 1,000 investment companies or investee companies, and together that is worth more than 35% of their market cap. And you don't see that impact on income statements. So whenever you look at a valuation, you should always adjust for the value of that investment portfolio. So the next slide just shows you that, clearly, firstly, if you look at Tencent, actually has quite a diverse revenue stream. So if you're worried about regulation that targets a specific area of the business, offsetting that is the fact that they do have quite a lot of areas that they have been growing into, and you can clearly see that our management has been able to generate new revenue streams over time. And then if you think and you put that into the basket together with the Prosus other assets, you actually get end up with quite a diversified asset set. But clearly, if we look at the Tencent performance more recently, this chart just shows you the revenue growth as well as the earnings growth, and you can see growth has slowed down. So in the first quarter of this year, there has been no revenue growth, and earnings have declined by more than 20%. And unfortunately, for the second quarter, we expect similar performance from them. Now, the question is this an ex-growth company? In which case, you should be very careful not to anchor yourself to past share price or valuations, or is it more like the 2018 period where you've had a few more cyclical headwinds and the longer-term structural growth story is intact? It's very difficult to answer that question at the moment, but what we can say, I'll show in the next slide, talk a little bit about what the market is pricing in. So do we have a more attractive valuation that should protect you from downside, or can we identify certain cyclical factors that we expect not to repeat going forward? And I think certainly from a cyclical headwind point of view, there were very specific issues. Alvin has alluded to the fact that they've had very strict lockdowns in China due to the Chinese policymakers' zero COVID policy. So once again, that is short-term cyclical headwinds. Hopefully, as they recover out of that and provide the stimulus to the economy, that should, at least from an economic point of view, turn into a tailwind. And also, there were quite a lot of regulatory developments that they had to work through that's still in the base that will start to sort of clear the base from the third quarter. Moving on to, as I mentioned, valuation. So this on the left hand just shows you the price of Tencent versus next year's expected earnings. And you can see that, firstly, it is on the low end of its own history, but at a 22 times, it's certainly not a cheap company. So it's still a highly rated company. But just as I mentioned, they've got this big investment portfolio that we should adjust for. So the actual forward price to earnings multiple on much reduced earnings, hopefully cyclically low earnings, is 14 times. And then just remember, if you buy Naspers at a 40% discount, you run into single digit multiples. So it becomes more like a value stock. So let me conclude on Prosus. Firstly, it is a long-term investor in their own businesses. So as a shareholder, you should also have that long-term mindset when you assess them. Also, if we look at Prosus and Naspers on the JSE, it is really a unique business. So unfortunately, our market is dominated by, let's call it, more old economy kind of businesses like mining and banks. So the average South African investor on the JSE actually has a low exposure to new digital economy businesses. And then just finally, last year, we discussed quite a bit on our views on China's regulatory uncertainty. So I don't really want to repeat those things, but it remains a risk, and it's really dependent on how you weigh that up versus the long-term upside. And just also bear in mind that with the current share buyback program and sale of Tencent, that portion of Tencent, even though it remains a world-class asset, it will rebalance in the Prosus portfolio over time. And also, we will continue to make sure that when we offer a portfolio to clients, that we make sure that it remains well diversified. And a final point I want to leave you with is that the upside of the fact that interest rates go up means that there will be less cheap money into the system. So in the short term, it is bad for valuations that price off interest rates. But I think the upside in the longer term, it does impact competitors as well. And while we've seen really the focus on achieving growth at all costs for many of the global internet companies, I think that mindset has really changed, and the focus will be a lot more about, getting your cost base right, making sure you've got a profitable business model, and just be generally more rational competition. And if there are certain business areas that you don't think you've got competitive advantage and can succeed, you'll cut that losses. And it will also be much more difficult for new startups to come in because of how the funding has dried up for these businesses. So short-term gain, but I think if you've got a strong business model, at least also with Prosus investments, they do have a strong balance sheet where they can continue to support their businesses, but the environment should become more rational from a competitor point of view. Thank you very much.
Thank you, Renier, for a very insightful presentation. Somebody sent an email internally a week or two back, and he said, "Is this the end of the nightmare?" So when I listened to Renier, it seems to me it is the end of the nightmare, but you never know in financial markets because sentiment can change overnight. But Neri, thank you very much. Ladies and gentlemen, I think that wraps it up. I really want to thank you for your presence. I also want to thank you for your support. I know that it was quite a taxing period over the last 9 months, but I can assure you that not only did the Central Investment Research Team try to make a serious effort to try and understand the macro environment, but also trying to uncover specific asset situations, but also did our client-facing portfolio managers. They have come to the party, and they've also made a massive contribution to the research effort and the decision-making that we have taken in these portfolios. So to all of you, thank you very much. And I trust that when we talk again, that we will have better news, and that we will certainly see a recovery in some of the financial prices that we've included into your portfolios. Thank you very much.